So study unit 11 is where we're going to be starting, and study unit 11 is looking at forms of finance. Just to recap,
Yes.
at the end of study unit 10 or chapter 10, there was a small little self-assessment activity here after the summary, which spoke about some of the topics that were mentioned in chapter 10. So we're obviously building on that. Remember, topic 4 is looking at the forms of financing or the sources of finance. So where can we get capital? The first thing is two types of markets as potential sources of finance. Do you remember what the two markets are called?
There's the capital and the money market.
Okay, you can talk about capital and money. That's long-term and short-term. But remember primary and secondary.
Oh, okay.
What is primary?
Oh, yes. What was primary? I think the primary was, wasn't it like internal, where you get your money first? I can't remember.
Correct. When you first raise capital on an exchange.
Yes.
That's correct. You're right. And secondary is what?
I think it's like I said, maybe this one's like more external. So your next step in terms of loans and debt financing.
No, not quite. Okay, secondary is when other investors are buying and selling those shares or those bonds or those financial instruments.
Oh yes, now I remember. So
okay, for example, primary market would be going to the farm and buying milk.
Yes.
Okay. Secondary market would be going to a retailer, a store, and buying milk that's on the shelf.
Yes.
Okay, so the one is you're getting it direct from the supplier. In other words, you're raising capital from the company, you're selling shares from the company, or you're buying shares from the company.
Yes, I remember.
Okay.
The IPO.
Yeah, and then we spoke about money market and capital markets. That's good. You remembered that markets can be broken up into short-term and long-term.
Yes.
Money is the short-term, capital is the long-term.
Yes.
Okay, good. So we're looking at sources of finance. We're obviously looking at ways in which we can raise the capital or source the capital. Study unit 11 is looking at something slightly different, which is the forms of finance. So obviously form is different from source, because source is where do you get it. Okay, so in other words, the market, the JSE, the money market, the capital market, etc. Forms of finance is, well, if I'm raising capital, what type is its form? What is its type of capital exactly? Okay, type. Right, so they've summarized here. This diagram is quite nice because they look at what's going to come up in this unit. They talk about long-term financing. Then they talk about equity financing. Then they talk about long-term debt instruments, and then short-term financing. Notice all of those 4 blocks are describing a form of finance. Okay, a form meaning a type of finance.
Yes.
Okay, so we get long-term, we get short-term, and then we can even break it up further into other different examples like share capital, retained earnings, corporate bonds, long-term loans, bank overdrafts, bankers' acceptances, etc. Okay, there's a lot of different forms of finance. What do we need finance for, though? What is its purpose?
Well, it's to, I don't want to use the word again, but it's to finance the big projects that we have. So it's to be able to collect money so that we are able to inject money into expanding our business even more.
Correct. Good. So it's a resource that allows you to create outputs.
Yes.
Okay, so we need something to start with. We need inputs. Input could be time and effort. Input could be resources. Could be money, capital. It could be anything really. As long as you've input something. Okay, you've used something in order to generate some sort of output. And what do we say the output is in finance? What do we want to achieve? What's the primary goal?
Is to create long-term value and wealth.
Correct. Okay, value and wealth is important. Profit is just a measure of performance, okay, looking at income and expenses. But the focus is generally wealth or value creation. Okay, we're trying to create something worthwhile going forward, and that requires resources. Right, the introduction is just giving you a bit of scope in terms of the forms of finance, and then they talk about this. considerations. Long-term finance. Okay, so if we're looking at long-term, there's 4 things that they've mentioned here. There's actually 5. There's one more on the next page. The first is looking at trends. The next is looking at control. The third is looking at dividends. The fourth, liquidation. And the fifth is risk. Okay, so if I'm looking at those scenarios, so we're looking at long-term finance. We're looking at these considerations. If I'm looking at long-term, what time frame would you associate with long-term?
Wow. That's very, I don't know, I'd say within 10 years or so.
Within 10 years?
Well, 10 years and more.
10 years and more?
Yeah, I would think that's a long term.
Okay, that is quite long term. I would look at long term as being maybe more 5 years. 5 years. 5 years is a long time.
Yes, sir.
5 years or more. Okay, but it doesn't really matter what your definition is of long term. Okay, obviously long term is definitely going to be looking at the future. Okay, definitely not this month or next year even. It has to be 3, maybe 4, 5, 6, 7, 8, 10 years in the future that we'll be looking at in terms of long term. So if we're looking at the form of finance, when looking at long term, they talk about the debt tends to have a finite life. Okay, so if something tends to have a finite life, what happens to debt over its life? Does it get more or less?
If it has it should be getting less. So
why should it be getting less?
Well, it should be getting repaid.
Correct. Okay, you should be paying off your debts.
Yes, sir.
So when looking at long-term finance, the 2 key considerations here is debt versus equity. Okay, if I'm looking at debt, what are some of the advantages to debt? Are there any advantages?
That debt would be a lot cheaper than equity because
it could be because of what?
Because obviously, if investors are foregoing their dividends for their year to use those retained earnings to pump back into the company, they will probably be expecting, with great risk, they will probably be expecting much greater returns as well and much greater rewards. Whereas opposed in the if you're taking out a loan, it's a specific percentage that you'll be paying over a specific period of time, and you're not paying it all at once. So it's just a bit at a time, and it should be cheaper.
Okay, when you say cheaper, you're right, but it's cheaper not because of what you said in terms of dividends and paying out or not paying out, or investors wanting more compensation in terms of equity. It's cheaper because interest is tax deductible. So we can claim it as part of an operational expense depending on what the loan is used for. Okay, but it is cheaper, okay, because you are going to be able to claim interest. Right, if I'm looking at debts, does the borrower or the lender have any ownership in the company?
No, they shouldn't, sir. Other than if you're giving maybe surety of some sort, but that would be maybe an asset for the asset of the company. But
yeah, well, that would be secured or unsecured lending.
Yes.
Okay, but if we're just looking at debt, there's no ownership. Do you agree?
Yes, sir.
Okay, so once you've paid off the debt, is that asset yours?
Yes, sir.
Correct. Okay, so with debt, there's no ownership. There's no problem with control being lost if you were giving people equity in the business. Okay, because maybe at the same time, let's show equity on the right here. Equity is generally more expensive, so slightly more expensive, so more costly, because businesses have to give away part of their business, and in order for people to buy a stake in their company, it normally gets issued at a discount. And also dividends are paid after taxes. Okay, not before taxes, after taxes. There is ownership, so ownership is applicable. So you asked me a question about mergers and acquisitions, and obviously if someone buys enough of a company, do they control it?
Yes.
Yes, they do. And that's a very, very, very big consideration for a business that's using equity to run the business. In other words, they're giving away some of their ownership.
Yes, sir.
Okay, and that's a concern. Right, the textbook also talks about, well, the liquidation. Okay, so if I'm liquidated, who gets paid out first, the debt or the equity?
The debt gets paid out.
Creditors first. So when a business is liquidated, equity holders only get what's left over. It's the actual creditor or the people that are owed money in the form of a liability. They have access to that money before anything else can take place.
Yes.
So that's not so good from an equity point of view. But from a debt point of view, it's pretty good if you're looking at financing these businesses. Right, and number 5 is the risk. Do you think the one is more risky than the other?
Yes, sir.
Which one do you think is more risky?
I think debt could be a little more riskier, sir.
Okay, if you say debt is more risky, why would you say debt is more risky?
Well, well, I think debt is well. I think if you depend on which side you're looking from. If for debt, I think it would be riskier in the sense that in case you maybe falter on payments, but then also on equity it could be risky in the sense that you might not get your investment back as someone, in the sense that as someone who is giving money so it can be used as equity as an investor in shares or anything, and the business doesn't do well, then you lose that money. But in case maybe you take in debt, Standard Bank gives you a loan or whatever, and you use that debt to try to generate more income, and it doesn't work out the way that you imagined it, that could also be a potential risk.
Okay, so are you saying the one has more risk than the other?
I don't know. Like I said, depending on which side that I'm thinking from. But I do think if you're looking from an investor's point of view, then the equity would probably be a lot more riskier. So.
Okay, but if you're looking at equity, from the investor's point of view, they can lose all the equity, right?
Yes, so they could
so
lose
if they
all
invest and the company can't pay, or let's say the company has got too many obligations, who gets paid out first? The creditors.
The debt, yes, sir.
So you're right, in terms of risk for the people giving equity, they might not get anything back.
Yes, sir.
Because as you said, they're buying a portion of the business. So if I'm buying a portion of the business, if the business doesn't have any value, well then those shares are worth nothing.
Yes, sir.
Versus the debt, where debt could be recovered because there's an obligation to pay. Does that make sense?
Yes, sir.
Okay, so the one is looking more at an obligation that's required to be paid. So debt is risky depending on what are you using it to finance. Okay, because obviously, if I'm financing expenses with debt, that's going to create a problem in terms of cash flow. But if I'm trying to grow the business and if I'm financing assets, well, then that's a good thing to do.
Yes.
Okay, so the debt risk here would be maybe default or insolvency. Okay, that could be the risk, because think about it. If you can't pay your creditors, what's going to happen?
You're going to be declared insolvent.
Correct. You're going to go bankrupt, and those creditors are probably going to take legal action against you, right?
Yes.
But now, if we've got equity, if the business isn't making a profit, can the investors demand a dividend?
No, so they can't.
No, they can't. Okay, they don't have any say as such in terms of whether the business is going to pay out a dividend or not. If the business chooses to, great. If they don't, it's not something that is mandatory. It's something that has to be done. Right, but in terms of debt, it has to be done, meaning it has to be paid back. Right, so remember we spoke about SAA as an example?
Yes.
Okay, so SAA is currently in the news again because they're looking at getting bailout funds from the government. Okay, that's what's currently being spoken about in the media. Okay, in the news. Right, they're talking about SAA and how SAA is probably going to get saved again by government by injecting more capital in that business. Right, and why are they doing that? It's because of meeting obligations. SAA has many loans with different parties, and it's their responsibility to meet those obligations. If they don't meet those obligations, well, then legal action could actually be taken against that company because they haven't met the obligations, they've defaulted.
Yes.
Right, but if I'm looking at equity, if the company doesn't make a profit this year and they choose to not pay out a dividend, whose fault is that?
That's our fault. That's the company's fault.
Yeah, the business's fault for not making a profit.
Yes.
But can the investors demand a dividend then? Or can the investors demand something?
No, because they're also seen as part owners of some sort.
Correct. They're part owners of the business. So they don't have as much, let's say, legal not consequences really. It's they don't really have such a strong legal, let's say, case or view, okay, when looking at the company, okay, as a whole in terms of its lending. But we know if I borrow money and I borrow money from the bank, I have to pay it back according to the agreement.
Yes.
Right, there's risk there. If I don't pay it back, the bank will then take legal action against the business. Right, versus if I'm a shareholder and I've given money to the owners of the business in order to invest in the business, and then I get a stake of the business. If the business doesn't make a profit, can I demand a profit? Can I demand a payout?
No.
No, you can't. Okay, the reason for that is it's equity. You're actually owning a portion of the business. So you're an owner through good times and bad. Versus if you're a lender, you're just lending to that business and they need to pay you back before the due date. Right, do you see how the two differ?
Yes, sir.
Okay, good. Right, so that's what they've given you here in terms of a bit of a summary. They've given you debt on the left, equity on the right. The textbook's very good. They've tried to contrast those two things quite nicely as we were discussing it as well. Okay, let's talk about equity financing.
Yes.
Equity is shares.
Yes, sir.
It can also
And
be
retained earnings.
profits.
Yes.
Retained earnings. Right, equity is looking at internal sources of finance. That's what you're looking at. Okay, raising it within the business. Part owners. Alright, shareholders. Those are people that are, let's say, knowledgeable or comfortable with the workings of the business. Okay, they're inside the business. They understand the business. They choose to be shareholders, meaning they've given us capital to operate. And so long as we operate successfully, and if there is profits to be distributed, then we will distribute them to the shareholders as almost like a form of thank you for investing in that company.
Yes.
Okay, so the textbook talks about an ordinary share, and then they talk about a preference share. Do you know what the difference is?
I think an ordinary share, there's a much higher risk to the ordinary shares because they are the last people to get paid out.
Correct.
However, the preference share, they are given they're given they're given preference over the ordinary shares, so they're going to get paid first.
Correct.
Yes.
That's exactly right. Okay, so the one also has ownership as well, and the one is seen more as debt. Okay, so preference shares, they often talk about it as being quasi-debt. Quasi-debt meaning similar to debt, but it's not quite debt. It's equity, but it's in the form of a preference share. Right? And as you said, preference shareholders are requiring a dividend or a payout. They're obligated to pay. So if I'm looking at an ordinary preference share, well then that particular share is going to have to pay a dividend in perpetuity. Perpetuity meaning forever.
Yes.
Okay. Then you've got types of share capital here, ordinary shares, and you've got preference shares. And they've tried to give some information regarding each of the two types of shares. Right? Ordinary is very basic, very simple. It isn't as complicated. It's literally, do you want to own a part of the business? If so, here's a part of the business. As long as you pay capital for those shares, you're a shareholder. Okay, you're part of the business. You're part of the ownership of the business. Can share prices change?
Yes, sir.
Yes, they can. The prices can change, and so can the dividends. Dividends don't always have to be paid out. Dividends can range from a small amount to a large amount, special dividend or an extra dividend or a normal dividend, but it's always going to be something that the business is going to have to establish in terms of the company's ability to finance those payouts, okay, payouts of profit. Right, can we pay out a dividend? Well, the answer is yes, so long as we have the funds in order to meet those obligations.
Yes.
Okay, then they also talk about this, redeemable and convertible. Redeemable and convertible is looking at what? If something is convertible, what does that mean?
It means it can be changed from equity into debt.
Possibly. Yeah, so you could change it from equity to debt, or you could maybe change from preference to ordinary, depending on what the scenario is. Okay, but more often than not, it's going to be looking at changing it from debt to equity. Okay, or equity to debt. It's rather equity to debt. Okay, it's looking at shares. Okay. Right, variations of ordinary preference shares. Okay, if it's a variation, it's looking at a different type of share. So you get redeemable. There's the word redeemable. You get convertible, and you get participating. Okay, if something is redeemable, redeem means
it can be bought back.
You can buy it back, or you can sell it, basically.
Yes, sir.
Okay, so redeemable pref shares or shares. Okay, you can literally tell the company that they have to buy out your shares. They're redeemable. Right,
yes,
so
sir.
the investor, the shareholder, has an option to sell the shares. Okay, so redeemable is looking at shares with a maturity date. Right, almost like a bond, okay, where a bond will end at a specific point in time. If it's redeemable, that relationship will end at a specific point in time. Does that make sense?
Yes, sir.
Okay, so you're only a shareholder for a certain amount of time, right? And you have an option to sell. So when that option, or when that date comes, then those shares are going to be sold, and that's the end of the relationship or end of the business company. Okay, convertible, what does that mean? Well, convertible we spoke about means
can be changed.
To change, exactly. So if we've got convertible shares, we're going to be exchanging that or changing it into other financial assets. It could be anything.
Yes.
It could be another instrument, okay, in terms of equity. It could be another instrument altogether in terms of debt, right? So bonds, debentures, it could be anything, right? Where we're converting it from one type of capital to another. And the last one is participating. Okay, if it's participating, what does that mean? Well, participate means to
take part in the different I suppose the other forms of that same. That's how I understood. So if you've got an ordinary share, so I think you can maybe participate in the other. You can take part in the other forms of ordinary shares as well. I'm not sure if I'm correct or wrong.
Yeah, almost. You're on the right track. So when looking at this, you'll see here they describe it as the right to participate in the ordinary dividends, bonuses, or rights that are usually associated with ordinary ordinary shares. Okay, because these are preference shares. Right, so if you're giving someone preference and it's participating, that means those shares have more, let's say, scope or room, okay, to give you something back as the investor.
Yes.
Right. But at the same time, from the company's point of view, it's going to cost you more to issue if these shares are special, or if these shares have a specific component or characteristic. Makes sense?
Yes, sir.
Great. Right, then they've given you a note here about some amendments. Obviously, STC is what we call taxes on dividends in today's world. Right, back in 2012, they changed dividends tax to secondary tax on companies, STC. Okay, so that's a withholding tax on dividends.
Yes.
Right, so notice how much taxes businesses actually have to pay, because if you think about it, a business would have to pay tax on the income tax. Do you agree?
Yes, sir.
And then once they've paid a certain amount on their income tax, they still need to consider their other, let's say, areas of business. Okay, meaning if I'm going to be, let's say, employing someone on a, how can I put it? Let me think about STC. It's secondary, so meaning, so for example, you're an agent. You're collecting something on behalf of someone else, if that makes sense.
Yes, sir. Yes.
Okay, that's a form of STC, or withholding tax. Okay, withholding tax is literally the government instructing someone to do something in the form of a collection. Okay, so are we getting paid for our income tax? If the case is we are, then that payment would go to the actual liability.
Is it with? Yes, okay.
What's wrong?
No. So I was just gonna ask, is it like is it not like in the sense that when you're supposed to pay tax, like if I'm kind of an employer, this is how I thought about it. Like if you're an employer and you're getting paid money of some sort, and you don't directly have to pay your tax by yourself at SARS, the company withholds that tax and pays it on your behalf of some sort.
Correct. Yeah, withholding is exactly that. So it needs to be paid over to the person that it's liable, not liable, but it's due to. Okay, so obviously SARS, taxes are due to SARS. Right, but the business might act as an intermediary that's going to withhold those taxes on dividends. Because think about it this way. Would it be easier to collect tax on all the dividends from the investors, or would it be easier to collect all the dividends or taxes from the provider?
From the provider would be
definitely from the provider, because the provider would have hopefully better records as well, and it's easier to track one provider rather than 100 or 1,000,000 different people.
Yes, sir.
Okay, and that's why we've got a withholding tax on dividends. Okay, where, as you said, it's like an agency relationship where SARS allows a specific business to collect taxes on their behalf.
Yes.
Right, then they talk about advantages of the organization in terms of pref shares. They talk about leverage and dilution. That's something that we spoke about earlier when we looked at this. Ownership.
Yes, sir.
Okay, so what is leverage?
Oh, when you have leverage, I think it's you almost have, I suppose, an advantage of some sort over someone, or you have something that someone could possibly want. Hello?
Correct. What
Yes.
else?
Yeah, that's what I can think of right now.
Yeah, leverage is also, how can I say, power or influence in a way.
Yes.
Okay, because you'll be able to do more with less. Okay, if you have leverage. Okay, it's like a lever. Right, so in a lever, you can either make it more or easier to pick up a certain amount of weight. Okay, because that's the nature of a lever. A lever would be used for lifting things. So if I'm looking at leverage, leverage would be a way to maximize, okay, get more than what you currently have, or than what you currently have that you're going to be investing. Okay, right. So leverage here is looking at the extent in terms of how much debt or equity we're going to use. Right, financial leverage. You get two types of leverage: financial leverage and operating leverage. I see in this chapter they just look at the finance side of things, which is fine. Okay, so financial leverage.
Yes.
Okay, do you agree if we're looking at financial leverage, we're looking at how, let's say, successful or how productive are we with the actual...
With the debt? No?
Well, not really debt, it's more the operations of the business. How efficient is the business? How soon or how late do we pay our debt? Okay, our creditors. So financial leverage is the extent in which redeemable preference shares are used in the capital structure of an organization. Okay, leverage meaning how much debt we're going to use. How heavily indebted is the business? Okay, so high, they call it gearing or leverage. Okay, so having too much debt. Is that a good thing?
I don't think it's a good thing, but then that does show, I suppose, financial institutions and credit institutions that we are capable of paying back any sort of money that we are lent. So it's like you trying to buy a house now without any kind of credit history.
Correct.
You're not going to be that successful. But if you do have a credit history of paying some sort of bills, lights, electricity, accounts, that does work in your favor to some extent.
Exactly, correct. Good. So when looking at having too much debt, it can be bad, but it actually maximizes returns as well. Because think about the shareholders. Are the shareholders going to give more resources? Do they have to give more resources?
No, they don't.
No, they don't. They don't have to. Right, so when looking at something like financial leverage, we're looking at how, let's say, what's the right word? How much do they rely, okay, on the actual providers, okay, in terms of debt? How much do you rely on those people, basically?
Yes, sir.
Okay, so financial leverage is looking at that. It's looking at how much debt do you have, how much do you rely on those people to finance your business, to keep your business afloat. Okay, and then you've got this dilution. What does it mean to dilute something?
So is it?
What does it mean to dilute something?
It needs to mix it.
Well, to mix it in order to do what?
Then maybe you mixing it to try create something new, or to
reduce the concentration.
Oh yes.
Okay, so let's think about a business that's running a business. Okay, concentration is who actually owns the business. Do you agree there could be a few individuals that actually own or that hold quite a lot of shares in a particular company?
Yes, sir.
Okay, that gives them leverage. But dilution is looking at the reduction of that concentration. Okay, where businesses aren't holding as much equity in that particular business. They're holding less. Okay, that's a form of dilution. Makes sense?
Yes.
Okay, so dilution is when new shares are issued. Obviously, new shareholders mean less ownership,
Yes.
for a particular company or business, depending on what they're actually doing, how many shares they're actually buying. Okay. Then we've got retained earnings. What is that?
Retained earnings. It's the earnings or the income that we might have made during the year that we didn't distribute as dividends, and that we're keeping it to be able to run the business in the following financial year.
Correct. Good. Okay, so something that we're retaining, meaning we're going to use it in the future for something. Good. Right,
Yes.
that's retained earnings. Then you've got long-term debt instruments. Okay, that's the other category. Right, so if we're looking at long-term debt, the most obvious one that you're familiar with is bonds.
Yes, sir.
Okay, you've calculated bonds in DSC. Right, so
Yes.
we're looking at, okay, this was equity. No, was it equity? I think it was equity, hey?
What a bond.
No, the first bit. Oh, this was the pref shares. The pref shares. The first bit that we're looking at. Okay, financial
yes.
dissolution. Okay, they gave examples here of preference shares. Right, that's fine. Long-term debt. Long-term debt is looking at.
Oh, here we're looking at bonds and the debentures.
Yeah, but duration though?
Oh, duration. I don't know.
Long term.
It's long term, so 5 years to 10, like you said.
Yeah, well, it's generally like depending on what asset you're actually considering. But yes, there will be a certain amount of time that will be associated with it.
Yes.
Okay, so if I'm focusing on this long-term debt, we're looking at bonds, debentures.
Yes. Yes.
Why do credit ratings rate the debt?
Isn't it like to see how well you're able to pay?
Exactly, why?
To see if you're a good creditor or you're a good debtor, so that other people are able to be able to finance you as well when you are looking for debt financing. So to say that yes, this person, or rather this country, is able to pay back their finances, they're able to pay back their debt, and so their rating isn't as bad as another country. So just so we're able to be able to ask for more finance from other institutions.
Yes. Okay, so do you agree that if I'm looking at equity, okay, a credit rating is going to be for what? The company, right? The business being checked.
Yes. Yes, sir.
Okay, so we're looking at this. We're looking at the rating agency's role that they play in this relationship. Okay, remember it's all connected.
Yes, sir.
Okay, so if it's interconnected and we're looking at a house that's being sold, okay, is that house going to be sold because of its size? Probably not. It's going to be sold based on its appearance, its food. Okay, the food and all of that can help with the impression that you give in terms of, let's say, raising or hosting that event. Okay, but it's all not. I said event. It's more the raising of capital, the issuing of capital, the IPO. Okay, or the finance, the selling of shares. Okay, so if we're going to be doing something, okay, we're going to be doing something that's either going to be helping the business or harming the business. And the rating agencies determine what helps and harms the business. And then they get a scorecard.
Yes.
Okay, that basically tells you this business is doing well or not. Okay, so an event can affect the rating agency's opinion. Okay, so not so long ago, we had all sorts of things happen in terms of the rand weakening and Brexit and all sorts of world events. Okay, so those events can create problems for companies because their ratings could be affected.
Yes, sir.
Okay, and ratings are important because ratings determine how much risk there is. And do investors want to take lots of risk?
Well, if there's good reward associated with it.
True, so it depends on what they're comfortable with. Okay, what
Yes.
risk level are they comfortable with? And that's why rating agencies give that information. Right, they talk about triple B, triple A, triple C, all of those different rating agencies. Okay, so currently South Africa is just one above junk status. Okay, we're literally bordering on junk status in terms of having a very poor rating, in terms of being being willing to pay on our outstanding commitments. Okay, paying back the loans
Yes.
that we owe. Makes sense. Okay, corporate bonds, debentures you've seen in DSC 1630. Those are forms of debt instruments. Then they've given you some activities here, advantages to the organization of issuing corporate bonds or debentures. What's the biggest advantage? We spoke about it earlier. Why is debt a better option?
Sir? Why is debt a better option? Well, that is cheaper.
It is, well, that's not the main reason. What would the main reason be for issuing debt rather than equity? Think about it.
I don't know. Maybe because that there's no ownership.
Exactly. That's probably the biggest factor to consider is, are you giving someone a part of the business? Okay,
Yes.
so advantages could also cover things like what ratings do those individuals have or do those businesses have? Okay, what is its cost? Okay, how efficient are they with managing their costs? But are costs contained? Are costs managed? Or are costs just random, okay, and not authorized? Okay, that's a problem. Okay, so when focusing on advantages of the organization when issuing corporate bonds obviously are slightly cheaper, as you said, because interest is tax deductible. Another reason could be, well, after having paid off the obligation, there is no obligation. Okay, what's yours is yours in terms of equity and what's left over. Okay, so that's why raising capital is important, because the more capital you raise, the more you can hopefully do in terms of output or resources that are created.
Yes.
Okay, so long-term loans, he's looking at things that are over a longer period of time, and a mortgage would be for property, sale and leaseback. Is a sale and leaseback a form of finance?
Sir?
Is a sale and leaseback a form of finance?
Yeah, I think so.
Okay, so let's talk about the sale and leaseback. Okay, let me ask you this. You're
Yes,
a photographer, so you're buying equipment in order to take photos. Do you agree?
Yes, sir.
Do you agree that equipment gets outdated and you probably need to change it after a certain number of years?
Yes, sir.
Okay, so if I'm looking at sale and leaseback, what is more important, the ability to use the camera or the ability to own the camera?
I think it's to be able to use it more than anything.
Exactly, the use is more important, correct? So if you're using a particular asset, okay, that asset is going to be considered what?
If I'm using it.
Yes. It's capital that you've employed in the business.
Yes, sir.
Okay, so if you've employed capital, if you've used capital to do something, okay, we're looking at the sale and the leaseback. So do I need the camera to take photos?
Well, I need it,
Yes.
but I don't need to own it.
But you don't have to own it,
out.
exactly.
Yes.
Okay, so how does it help the business?
Well, it helps the business in the sense that I suppose I won't have to be paying for, in the sense that if I own it, that I wouldn't have to be paying the additional costs, so the costs in terms of insurance and maintenance and so on and so forth. So I only use it for that one particular moment, and I send it back, and I pay for just the usage of it. But then in the sense that if I owned it, I'd have to pay for like I said, insurance. I'd have to pay for in case if it gets stolen, I might have to replace that, and so it would be cheaper actually to. It would be in some cases it would be cheaper to just lease it every now and again as opposed to having it as my own asset and having to pay all these additional things.
Correct. And if you're selling it to lease it back, what are you doing? So you're saying, well, okay, so you've got a camera that you're using, but other photographers can also use it, right?
Yes, sir.
So what could you do? Well, as a form of finance, you could say, well, okay, all my fans, all my followers, example, right? Would
Yes.
you be willing to contribute towards this or that? And is that a form of financing?
Yes,
Yes, it is.
If you're getting,
Yeah,
yes,
same
you're
as
getting
a sell and leaseback. Sell and leaseback just means you're taking an asset that you are considered worth a lot, okay, or valuable, and you're going to sell it to someone, meaning you're going to transfer the ownership, but you're still entitled to the output. Okay?
to
In
the
other words,
rewards of
you're still going to get the benefit, okay, the leverage.
yes.
The benefit. You can still use the asset. You can still use whatever it is. The only problem is you need to confirm, okay, in terms of its
Yes.
use, right? How is that going to affect the business cash flow? Because cash flow is key. Okay, remember businesses fail because they don't have cash flow, not because they don't manage their profit or make a profit.
Yes, sir.
Okay, so value is always important. Always important. Knowing how much that particular asset is worth. Okay. Right, so sell and leaseback is a form of financing because it sells something today to raise capital, but we then lose ownership.
Ownership. Yeah.
Okay, so you're selling something and then you're leasing the exact same thing back. Okay, it's a form of financing. That's what you would use there in terms of sell and lease back. And then we have a bank loan, which can be long-term or short-term or medium-term, depending on the situation. I think that's pretty straightforward. Installment sale agreement. Do you know what an installment sale agreement is?
No, sir, I'm not quite clear up on.
Installment means?
Payment.
When?
It's at the end of each period, or over the usage, I suppose.
Over the usage? You could, but an installment would be the payment for every single period. Okay, so obviously paying off a certain amount here, paying off a certain amount there. If we're looking at an installment would be a payment that doesn't have any, how can I put it? Equity. It's purely debt, but it's an installment for it. So it's a regular recurring. It's almost like a dividend. You were saying we're going to pay out a dividend. Here we're saying we're going to pay out a installment. Basically, we're going to pay an installment. So if I'm paying an installment, I'm going to pay off an item. Okay, it's getting paid off over time. Right? Do you own the item? Is it yours?
No, not up until you finish the payment.
Correct. Okay, always something to consider. Good. Okay, so businesses often need to look at their customer base. Okay, and how big is their customer base in order to make a decision on whether or not we can offer sales, okay, and installment payments. But remember, installment payments for the business, does that help the business? Well, yes, because it can boost sales.
Yes.
But comes at a cost. Why? Not everyone pays.
Yes.
Okay, so boosting sales, but also creating more bad debt, possibly. Right, then they've given you just some notes here at the bottom about short-term financing. Okay, short-term is looking at day-to-day. Okay, this is looking at debt, short-term financing. Generally operations. Okay, and that's why if you're looking at a cash flow statement, you would have a statement of cash flow as well as all the other statements, because businesses are interested in seeing how the business is actually performing.
Yes.
Right, that gives you a much better view. Right, so the examples here, bank overdrafts. What is a bank overdraft? Do you remember? Some accounting.
Yeah, it's when the business allows you to, I suppose, almost tap into some sort of a credit facility. Correct. Where they allow you to use more money than what you actually have.
Good. Why would that be a good idea?
In terms of the business?
Yeah.
Well, especially if your debtors aren't paying on time, so you might need to tap into it so that you're able to use the money to generate more income, or use it to pay off something else, or just generally you use money while waiting for your debtors to pay, or waiting for sales to pick up.
Okay, so do you agree? It's a way of managing short-term obligations.
Yes, sir.
Right, because those short-term obligations are the most important ones. Okay, because it's the short term, it's the little actions, it's the small things we do that make those bigger differences. Okay, so with day-to-day finance, you look at operations. Right, so what are we doing every day, day in and day out? And obviously, that's going to contribute towards where your end goal is. Is that right?
Yes, that's all right.
Okay, so it's always obligations. Bank overdraft, meeting the obligation to the bank because you've taken more than what's in your account. Bankers' acceptances, here the bank actually acknowledges that bill that you've written out, okay, as being made to be worth a certain amount. Okay, big amount, small amount, doesn't really matter, but it's looking at what does the bank guarantee or accept. Okay, banks will guarantee or accept a specific amount in line with their rules.
Yes.
Okay, then you've got finance secured by a debtor's book. Okay, are debtors good? Yes, because they're assets. But if they don't pay, they become liabilities. So how can I avoid them not paying? Factoring. What is factoring? This is selling your debtor's book. Okay, so I'm not going to be collecting debtors myself. I'm going to outsource it to a separate business. They need to collect from the customer, the tenant. Okay.
So is that like outsourcing to debt collection?
If you outsource to a debt collector, it wouldn't be factoring. Factoring is when you actually physically give value to that particular individual.
Okay.
Okay, so it's like factoring. So I've sold something to someone. Okay, that person owes me, but now I'm going to factor my debt. I'm going to ask you, well, are you willing to pay X for this business's debt? Okay, because debt is the asset. Remember, debt is only an asset if you can repay.
Yes.
Okay, so all the rubbish and that gets thrown out, okay, would be seen as almost like excess, things that we don't require. Factoring are things that we require in terms of cash flow, but we keep what we need as a necessity, and then we factor or sell what's left over. Okay, the stuff that isn't being used, that's not required, that's not needed. Is that alright? Okay, so just remember that factoring is always about the business. What can the business afford?
Yes,
we were looking at its purpose. So we know that debtors are a form of asset to the business. We know factoring allows us to sell our debtors book. Why would we want to sell our debtors book?
I don't know. Perhaps maybe the debtors aren't paying so well.
Possibly, but factoring would be a way to speed up the collection, right?
Oh, yes, sir.
Because now we sell the debtor's book to a debt collector. Right, so in other words, instead of having to wait and collect, we're saying, well, why not let's receive all of it up front. Let's just get a debt collector to give us the full amount. Well, not full amount. It'll obviously be a discount. They'll never give you the full amount. But if you're charging a margin or a profit on the goods that you've sold, okay, you might not mind giving a slightly lesser amount to the actual debt collector in return for cash today.
Yes, sir.
Okay, so you're going to take a cut of the actual total. You'll accept less than what is owed, but at least then you don't have the headache or the administration or the burden of collecting outstanding debtors.
Yes, sir.
Okay, so that's factoring. Okay, then you've got revolving credit. Revolving credit is something that a business can apply for where they don't always have to apply for credit. So remember, businesses don't want to always apply for credit. Do you agree?
Yes, sir.
So revolving credit allows you. Revolving credit is it's a way to allow for credit to be given that has been previously accepted. Okay, so it's almost like accessing an amount of credit that is allowed to the business because of a relationship between the business and the creditor. Right, so revolving credit is just a way to help with the speed at which businesses operate. Okay, it's revolving. Revolving meaning it's an amount of money that is available. Okay, it's kept within the business's facility. Right, so here they've described it as allowing the organization to withdraw money up to the original credit limit once a certain percentage has been repaid and or excess cash can be paid into the account and withdrawn later when needed. Okay, it's a form of financing. Remember, form, type of finance. That's what we're looking at here. Right, so revolving credit is another form of finance. People can use it in order to operate.
Yes, sir.
Okay, creditors. Do we like them?
Yes, sir.
Why?
Well, they're the ones that supply us with the raw materials or the goods that we resell.
Correct. Supplying goods now and paying later.
Yes, sir.
Good or bad idea?
Well, it could be a good idea, especially if you're gonna be, because obviously you're gonna be selling your these goods at a selling price.
Correct.
Which is obviously much higher than a cost price. So if you're able to receive all of that money before, and then you're able to pay them back later.
Correct.
And still be able to keep some of the money. Yes.
Correct. Good. Yeah, it's a good answer. So obviously you want businesses to meet their obligations. Okay, so obviously the more trustworthy you are as a business, the more easy it is going to be in order to secure better terms with that particular supplier. Right, because remember, you rely on suppliers to operate. So if your suppliers can't supply you with goods or services, that creates a problem for the business.
Yes, sir.
Okay, so creditors is definitely a form of finance. It's allowing to buy something today and pay for it in the future.
Yes, sir.
Right, then I think that's it. Yes, then that's the end of that chapter. Okay, lots and lots and lots and lots of theory there. Right, there's hardly any calculations there. It's all theory. Right, so I would encourage you just to go over that again and just read the detail regarding each of the different forms of finance. Okay, but remember, it's a form of finance, so it's just a type of finance. It's something that we can find that can help us with our operations.
Yes.
Okay. Right, this chapter is important because now we're looking at calculations. Okay, cost of capital is a calculation. Capital structure, it's something to consider. It's not really a specific calculation, but it is something that we need to be mindful of because there's only two real types of capital. Okay, debt and equity. That's what we're focusing on. Okay, you'll see they've split this into three separate parts. Okay, the theory, then the cost of capital, and then the weighted average cost of capital. Right, 13 and 14 is important in terms of calculations. 12 is generally just the theory, okay, the background information regarding it. Right, so chapter 12, or study unit 12. Capital structure. Okay, when you see the word capital structure, what comes to mind first?
Capital structure. Well, I just think capital, so money that we are reinvesting into a business.
Good. Capital structure is money related. Structure is how is it structured. Okay, so in other words,
Yeah.
resources broken up into different sources or forms.
Yes.
Finance. Okay, and that's what the previous chapter was looking at in terms of theory. The previous chapter was telling you what all the different forms of finances are. Okay, we can use equity, we can use bonds, we can use revolving credit, we can use bank overdrafts, we can use anything, so long as it does what for the business? Creates value or provides resources. If the business has sufficient resources, will they be able to operate?
Yes, so they will.
Yes, they will. If a business has sufficient resources, will they be able to expand?
Yes, sir.
Yes, they will. Okay, so businesses need resources in order to operate. Right, so when looking at capital structure, we're looking at a percentage of debt and a percentage of equity. Okay, because remember,
Yes.
debt and equity are the two main sources of finance. You do get lots of different types of debt, and you get a lot of different types of equity. But at the end of the day, equity is equity, debt is debt. You need to decide how much do I use of each of them. Okay,
Yes.
does that make sense?
Yes.
Okay, so when focusing on theory is important. Okay, so I'm just going to cover the theory, and then we'll take a quick break, and then we'll come back and look at the calculations. Right, when looking at capital theory, if I'm focusing on theory, we're looking at principles that apply. Right, and here they've looked at three things. Okay, capital structure, benefit, which is the debt, okay, or equity even, we'll consider that as well later on. And then they talk about a target capital structure. If you're targeting a specific capital structure, what does that mean?
Perhaps you're trying to ensure that that's the specific structure which you are going for.
Correct. Okay, so you're not going to go too much in one direction, too much in the other direction. It needs to be balanced in terms of the structure. Okay, so the structure in terms of debt and equity need to always add up to 100. Okay, 100%.
Yes.
Right, meaning a percentage goes to this area, a percentage goes to another area. Okay, that's some of your statistics. Right, so in this
Yes.
particular scenario, capital structure is just look at the breakup or the breakdown. Okay, the breakdown of debt and equity. That's all it is. It's just looking at how much of the one are we using versus the other.
Yes.
Right, so they define capital structure as being very specific here. They gave you the definition. They say it's the manner in which the organization's non-current assets are financed. See, we know that. Assets can only be bought
Yes.
by using two things, debt or equity. Okay, that's the basic accounting equation, right?
Yes, sir.
A equals OE plus L.
Yes.
Okay. So when focusing on debts, debt is money that we borrow. So what type of account would that be viewed as? Asset or liability?
Debt would be a liability, sir.
Liability. Okay, give me two characteristics of debt. Stuff we spoke about earlier.
Whoa. Characteristic of I think if I'm thinking about the correct, I think that it can be there's no ownership when debt is taken out. It can be cheaper.
Okay,
cheaper
definitely.
to obtain, and it can be repaid over a specific over a longer period of time.
Correct.
And yeah, I don't know what else.
Okay, so as long as you've got those points, that's fine, because you just look at the characteristics. So what would our reason be for taking out a credit facility, okay, in the form of a revolving credit agreement, okay, or why would we want to sell equity in our business? Right, so capital structure is our choice. You need to decide, what are you willing to give away? Are you happy to give away 30%, 40%, 50% of your business? That's what we need to consider.
Yes.
And that all comes down to how aggressive or how conservative the business is, because capital structure, debt is an aggressive way to grow or expand. Okay, because now you're actively seeking resources in order to quickly grow and expand. The other is equity, which is more patient and long term. Okay, it's called conservative. Okay, so if you're conservative, you're more cautious. Right, you're more careful. Right, and that's what we're looking at here with capital structure. We need to know how careful or how cautious or how aggressive a particular business is.
Yes.
Okay, and that's capital structure. Right, debt, equity, pref shares. Then they've given you a note here about the debt and equity ratio. This is something that you probably would have covered in other modules, okay, your accounting module, as well as some other finance modules. In this one, we're looking at debt and equity, having that equation. Okay, debt equals equity. Okay, well, debt equals probably wasn't the right word to use. It's debt to equity, so debt colon equity. Right, so what?
So the ratio should always be 1:1.
How many parts of debt do I use? How many parts of equity do I use in terms of the total financing?
Yes.
Is that right?
Yes, that's right.
Okay. So if I look at this, how much does this business require?
Well, this business requires 100 million.
Good. How is the business financing the 100 million?
It's broken up into debt and equity. So
good.
I suppose it's either selling shares or taking from retained income.
That's still equity. Okay, so if you're talking about taking shares or dividends, that's equity. And if you're talking about a
loan,
that'll be debt. That's the opposite.
Yes. Yeah. No, so I was just saying like how much it needs and how it was broken up. That's where I was going.
Okay, yeah, that's fine. Right. So would you say this company is more conservative or more aggressive?
I think it's more conservative because
true, but
it's.
But if we did have more information, we could probably say, well, this business is either going to be generating profit or not, and it's our ability to sell those goods that will either keep the business open or not. Does that make sense?
Yes, sir.
Okay, so is this business very aggressive?
Like I said, from what I see, it doesn't. I mean, it's aggressive in the sense that they did take out some sort of debt, but then they've taken out more equity than they have debt, or they've used their equity resources more than they've used their debt resources to get how much that they actually need for the business.
Yeah. So in terms of risk, which is more risky?
Between equity and debt.
Yes, between the two. Well, we'll look at our example. So if I'm looking at an example, you told me this company is more aggressive or conservative. Which one? Which one are you going to go with as a final answer?
I was still saying conservative, sir.
I would go more aggressive. Well, aggressive if they had more debt than equity. So you're right. Here they had 60 million equity, 40 million debt. Yes. So it's actually less aggressive, more conservative.
Yes, sir.
Correct. Yeah. So that's fine. Okay. So it's a portion of the total. That's what you need. Right, yes, earlier we spoke about leverage. They've mentioned it here again. Did they talk about other leverage? No, they didn't. They just talked about financial leverage. Okay, so financial leverage is obviously giving someone the ability to convert maybe shares or maybe cash into something separate or different. Right, so giving the financial leverage is the extent to which debt and redeemable preference shares are used in the capital structure of an organization. Right, why? What is the capital structure telling you about the business? How successful or how unsuccessful it is. Do you agree? Is the business going to use more debt or equity? Do you agree? We had to identify its strategy. If a business is more aggressive, which one would they use more of, debt or equity?
They'd be using more debt. So.
Exactly. They'd be using more debt because that's external finance versus equity, which is internal. Do you agree?
Yes, sir.
Good. Right, then they've got a note here with return on assets. Okay, that's a ratio. You can actually calculate the return on assets. You can calculate the return on equity. All of those measures just tell you something about the ability of the business to generate this, a return. Okay, remember we spoke about a little bit of risk and return? Obviously, yes. Businesses need to take risk, and if they're risking resources, they need to try and maximize the return. So the return on assets and the return on equity is just a measure of performance. It's looking at the abilities, the company's ability to generate a return using either its resources, being its assets. So assets would be your capacity to operate. So your computer equipment, your machinery, your land, your buildings, etc. And we're looking at what sort of output is this going to have on our business? What are we going to be creating? What are we going to be generating?
Yes, sir.
The return on assets and return on equity is basically a measure of return. In other words, how productive are we with our assets, or what sort of return did we get on the capital that we've invested? Okay, they're just measures. They're measures that help us with decision making.
Yes, sir.
Okay, then the next bit over here is just an example. We've obviously looked at some of these in your assignment where you've had to use a formula. It'll probably come up later on as well again. This is important, target capital structure. If it's a targeted capital structure, what does that mean? Think about a target. If you're targeting something, what does that mean?
I want to say either you're trying to influence it or you're trying to capture it specifically. So, or you're trying to get it specifically. So, you're trying to get that very specific capital structure.
Yes, good. You're maintaining a specific level of debt and equity. Okay, it'll never be perfect. So you'll never always have like 50%, 50% or 40%, 60%. Because remember, you incur interest on your debt, okay, that you have to pay off, yes. and you might issue more shares or you might not, depending on the scenarios. So it'll never be exact, but companies tend to target a specific capital structure. And why do they do that? It's consistency.
Yes.
Consistency. Right, businesses or investors like consistency. They need to know that a particular company is going to be consistent in terms of its decision making. So using a certain amount of debt versus equity.
Yes.
Right, then they've given you an example there, which is a bit of a case study. They've given you a note about investing and financing. We've discussed that before. Remember, investing is looking at what do I get in terms of return. That's the focus. Financing is looking more at the costs. How much resources do I have to invest or put into this project?
Yes.
Right, then there's a few activities there, and that summarizes the end of that bit. Okay, so now we need to look at the calculations. Perfect. So you've got a pretty good idea of what cost means. Cost would be the expense that you're going to have to incur because you've raised capital. Right, so what would the cost of debt be? Interest.
Yes.
What would the cost of equity be?
Dividends.
Good. Right, so those are the two different costs of capital. Cost is referring to how much does it actually cost us in order to obtain that finance. Okay, because remember, money comes at a price. If you're going to want to take out a loan, you're going to have to pay interest. If you're going to want to ask investors to invest in your company, you're going to have to pay them a dividend.
Yes.
Okay, that's what you're looking at here. So in study unit 13, they're looking at the background regarding cost of capital. Right, later on you'll see there's a weighted average cost of capital. Right, so when we did the second assignment, okay, remember we haven't covered all the theory when we did it because the assignment was due earlier in the semester. We spoke about terms like weighted average cost of capital. We just didn't cover the theory. We also spoke about the cost of capital. Now we're looking at it here. So these are important chapters. They're important not only for this module or study unit, it's important for other areas as well because it does filter into other decision-making areas. So the diagram has split up this chapter into different categories. Okay, obviously, you need to determine what the cost is of each capital before you can work out the weighted average cost of capital. Right, so cost of capital is going to be looking at calculating or determining the individual costs for different forms of finance. Right, so we spoke about where businesses can get finance. Okay, bonds, shares, be it preference or ordinary. And then in chapter 13, we need to look at measuring the cost of capital.
Yes.
Right, and that's basically what you're focusing on here in chapter 13. Right, study unit 13. Right, so cost of capital is what they've defined here as being the minimum return that the providers of capital require in order to invest. Okay, so why do we need a cost of capital? Well, do you agree? We spoke about risk and return, right?
Yes, sir.
Okay, so if I'm looking at risk and return, am I going to risk more if I don't get a return?
No, sir.
No, you won't. So if you know something is going to cost you 10, would you sell it for 5?
No, sir.
Why not?
Because the risk doesn't match the reward, sir.
Correct. Okay, so the risk is looking at the cost that you're going to be incurring when investing. Okay, risk and return. Right, so the cost part is the most important bit. Can I control my costs?
Well, to some extent, some yes, but then others you can't, sir.
Correct. Some costs can be managed or controlled. Some, as you said, can't. When looking at cost of capital, we're looking at how much does it actually cost us when using that form of finance. The textbook also talks about opportunity costs. We know that opportunity costs are part of decision making because
It's what you forgo for.
if you lose out on something, that's part of the cost of having made the decision. Right, so anything that we forego or that we give up would also be included in the calculation because opportunity costs affect decision making.
Yes, sir.
Okay, then you've got the effective cost of finance, which is basically your EFF, which you know from DSC. Okay, you get an effective rate and you get a nominal rate. Effective takes compounding into consideration. It takes all the other costs into consideration. So if I'm asked to pay a fee for a specific account, that fee will be part of the effective cost.
Yes, sir.
Okay, so we know that there's a linear relationship between risk and reward. Okay, businesses need to adhere to the risk-reward relationship. Meaning we're only going to invest when return exceeds the costs. Okay, in other words, the risk. Right, you're not going to be investing in a project that isn't going to at least cover your costs. Does that make sense?
Yes, sir.
Great. Right, then they've talked about the market value of financial instruments. Is this an easy thing to determine?
the market value. I don't think so. So because it doesn't the market value fluctuate?
Correct.
Okay, so as I think it fluctuates with the more something is bought or discarded. Because like I'm thinking about maybe the market value of like shares, for example. If or rather actually the currency, or the currency is not the same price as it is in the morning as it was last night.
Correct.
Or at the end of the day.
And how does that affect decision making?
Well, so I think it affects decision making in the sense that you have to make a sort of an allowance for that. So because as much as we try to be as consistent as we want to be, but certain factors come into play, and so that sometimes as like an investor, even as a business, you have to make like I said, you have to make room for the value going up or going down. So you might find yourself putting away more as opposed to putting away exactly how much you would have calculated. So just in case that it ends up costing a little more, or maybe just so that you're able to cover all sides of the spectrum.
Correct. That's good. Okay, you're right. So market value is a very difficult thing to measure reliably because everyone has a different opinion. As you said, the cost of certain goods or the cost of certain products or the cost of currency or the cost of shares or the cost of anything, okay, can fluctuate and can change. And it normally changes because of people's perception. So someone believes that that product is a really valuable item, and someone would then be able to pay or would be willing to pay more for that item. Right, so there's no, let's say, how can I put it, exact science when determining what the actual market value is, because market value changes often. Right, but we need to try and measure it as reliably as possible. And that's why we use certain formulas and time value of money concepts in order to apply that to different forms of finance. Okay, so cost of debt, there's the first one. Right, so if I'm looking at the market value or the cost of debt, what do you think I'm going to need to calculate it?
I think and what's it called? Is the rate of return or like an interest rate or at that moment?
Yeah, you need an interest rate. You would need time.
Yes.
You would need.
So you need an initial investment of some
possibly,
sort.
But we just look at the cost of debt. We might need a tax rate.
Tax rate.
Okay, why? Because interest is tax deductible.
Yeah.
Okay, so that means the cost of debt is actually lower than what it actually is, because tax will affect the cost of debt. Because when looking at decision making, we need to make decisions based on the after-tax cost of debt, what it actually costs us, not what it nominally costs us, if that makes sense.
Yes, sir.
Okay. Right, so the cost of debt is always something that you need to consider, and tax is very important. Okay, we know tax is always part of that. Right, then let's talk about a cost of bonds. What is the cost of a bond going to be? Here you can be more specific.
So is it?
Cost of a bond.
I think the cost of a bond. What would it entail, or what is it?
What is it? Think about your DSC.
I think a cost of the cost of a bond would be
which variable?
Well, I think time would be the most.
Not in.
Not in. Of the interest rate. Okay.
Yes. Yield to maturity. Okay, that's the cost of a bond. There's an important one. Okay, so in finance, when working out the cost of equity, you would look at the yield to maturity for a specific bond. Alright, so what am I going to need to do that? I'm going to need time. I'm going to need maturity value or future value, face value.
Yes, sir.
You're going to need par value. You're going to need coupons. Okay, and if I've got 4 of the 5 variables, I can solve for my I. Right, and I is going to represent the yield to maturity, which is actually the cost of a bond. Okay, because what is the cost of the bond? The cost of the bond is basically the interest that you're paying over time, taking compounding into consideration.
Yes, sir.
Okay. Alright, so there they talk about maturity date, which is your N. They talk about the nominal face value, which is your FV. They talk about the coupon interest rate, which is your PMT. Do you remember? All your DSC?
Yes, sir.
Okay, this is all DSC revision. Okay, it's just written differently with more language. Okay, coupon interest and so on. Right, market rate would be the interest rate, will be your yield to maturity. That's your I. Got that?
Yes, sir.
Okay. Do you need to worry about all of this? Have a look at these steps.
No, sir.
Why not?
Excuse me?
Are you going to be using formulas to work it out?
No, sir.
No, you're going to be using what?
My financial calculator.
Correct, financial calculator. Right, and because you've done DSC 1630, you've done a lot of bond calculations. And the bond calculations that you've done there are also quite complicated as well, because they looked at things like cum interest, X interest, and all of that. So definitely when looking at this particular section, as long as you can remember your DSC, you'll be fine. Just to explain what this formula means. This formula is literally taking everything in the future and discounting it back in time. Right, what is a debenture? A debenture is a series of cash flows, right, that are paid over time. Right, and we're going to present value the annuity, and we're going to present value the single amount. The single amount would be your FV. Future value comes back, all the coupons come back, so your PMT, and then you solve for your PV. PV represents the present value of the bond. If you had to solve for I, which is the interest rate, you would get the yield to maturity. And that rate would represent the cost of debt. Okay, there's the equation, there's the variables. Okay, don't worry about equations. You use your calculator for this, it's much better. Okay, there's step number 2, calculating the effective costs. Okay, effective cost meaning taking everything into consideration. That's compounding, that's fees, that's anything additional that you're going to have to pay. Here they talk about the yield to maturity, which you already know from DSC 1630. Yield to maturity is your I, it's your rate. And what type of instrument am I looking at? I'm looking at a bond. So what does the bond do? It discounts future cash flows back in time. So what cash flows do I discount? Well, there's 2. I discount the future value or the face value back in time, and I also discount the individual coupons back in time. Is that alright?
Yes, sir.
Perfect. Okay, so don't worry about this. This is just revision from DSC. Calculate the after-tax cost of that's important. Okay, so how do we calculate the after-tax cost of debt? Well, this is how. Okay, if before tax cost is, let's just say 23%. Okay, after tax costs would equal 23% times 1 minus 0.28, which is the tax rate. Does that make sense?
Yes, sir.
Okay, so it's 23 times 1 minus that. Okay, so if I take 23 and I times it by brackets 1 minus 0.28, I get 16.56, and that'll be my after tax cost of debt. Okay, that's how you work out after tax costs. Right, so it's literally calculate what the actual what the tax rate is in terms of 28%, and then you just subtract it from the 23, basically.
Yes.
Got that?
Yes, sir. Oh, yes. Income rate.
Okay, so that's what they've shown you here. There, 12% is before tax. If you want to take tax off, you times by 1 minus the tax rate.
Yes, sir.
Okay, which gives you that answer there. After tax cost of debt. Why do we take after tax cost of debt? It's because interest is tax deductible. That's why. There's the word. See that? Deductible.
Yes, sir.
Okay, so you need to take off the tax. Maybe let's do one example. Grab your financial calculator. Give me where is it? Okay, there, financial calculator. Using your financial calculator, I want you to give me the rate for this.
3.1 holds debentures at par. Excuse me. The annual interest rate is 15%. Okay. So
Identify variable, substitute, and solve.
alright. The first variable that I've identified is your N, that's your 5. Your the million, so would that be your PV?
A million debentures? How much is it worth? Par value, so it's R1,000,000.
Oh, yes, sir.
So if it's par value, it's FE.
FE. Okay. FE. At our 15%, it would be your I. No.
15% won't be your I.
No, it won't. No, sorry.
15% is what? Your coupon.
Yes.
What do I use the coupon rate to work out? The payment. What's 15% of a million?
15%, it's 150,000.
That's your PMT.
Okay, 150,000 is my PMT. And then the current market return for a similar debenture with a life of 20 years. Would 28 be your I, sir?
No, you need to work out because that's the cost of debt. So you need another variable. You need PMT. You've got PMT. You need PV.
Yes.
Okay, you've got N. N is 5 years.
Yes, sir.
Okay, so the current market value of similar debentures with a life of 5 years is 20%. What is that?
Is that your PV, sir?
That's your PV.
So
then you can work out your... No, that's not your PV.
200,000.
That's I. That's I.
Oh, the 20% is I.
Current market return, yes, I. Solve for PV. Do you get this? Where's your PV? Do you get do you get that?
Solve for PV 170. No.
Do that again.
No. Let me do that again.
PMT?
Oh, I didn't put in the
150,000.
150,000. 5 is my N.
5 is your N, 5 years.
20 is my I.
20 is your I.
So for...
No. Future value is a million.
Yes, I've done that one already.
Oh, okay. Solve for PV.
PV. 850,469.
There we go.
39 cents.
Okay, so you've got that, right?
Yes, sir.
That's the present value of that bond, loan. Okay, then the next question was, this was using that formula, that interpolating. Remember those equations and stuff?
Yes.
Okay, so yeah, that was that table that we saw last time.
Yes.
Okay, so don't worry about that. We're just looking at the calculator work. I wanted you to work out this one, number 2. There's it. Okay, work out the yield to maturity using the financial calculator.
So yield to maturity, we're working out our I, right?
You're working out your I, exactly.
Okay, so with the same details.
I think they did give the same details there, didn't they? Let's just check. Assume the current market value. Oh, here. Assume the current market value is the same as the one you calculated in A. So the answer that you got for A, the PV.
Yes.
Okay, you're going to use the PV. Put the PV in.
Okay.
Okay, so put the PV in that you had as an answer, and then put everything else in. Okay, and solve for I.
By PV. It's my payment, and I'm a solve for. Oh, sorry, that was wrong. Okay, so in this case, I'd still factor in my FV, right, sir?
FV you always put in because it's one of the variables. Remember, how many variables do you do with bond calculations? 4 of the 5.
4 of the 5.
Always. Okay, remember, how many time value of money variables do you have?
5.
5. N, I, PMT, PV, and FE. Okay, with the bond calculation, you insert 4 and you solve for the missing one. So I'm solving for I. Do you agree?
Yes, sir.
Okay, so what do I get?
Oh, so I keep getting the wrong answer. I don't know what I'm not putting in, and I'm
okay, start again. Shift, clear the calculator.
Yes.
Okay, let's use the figure that we have here. Initial outflow, which is the bond, 850,471. You insert that as your PV, but you have to make it minus. So after you've typed that in, press the plus minus button.
Okay.
Okay. Then put in 150,000 as your PMT.
Okay.
Then put in N as 5.
N is 5, yes, sir.
Put in R1,000,000 as your future value.
Future value.
Solve for I.
And 19.999.
There we go. Okay, so see, that's working backwards.
Yes.
Okay, but they gave you the 20% in the question. You saw that earlier, right?
No, I think what I did wrong was actually not adding the
plus minus.
Yes, sir.
Yes, I thought so.
Yeah.
Okay, because that's normally the case. Students forget to put the plus minus and it gives you an error.
Yeah.
Okay, because remember, PV and FV and PMT. Okay, those two should always be plus and plus. This one should be minus with the bond calculation.
Yes, sir.
Okay, great. So you know how to use the calculator. Then if I look at after tax, I just take off 28%. So you know what the yield to maturity is, 20%. You times it by 1 minus the tax, you land up with 14%, which is the after tax cost of what? Debt. Okay, so if I take out a loan, and the loan is being charged at 20%, effectively, it's going to cost me 14.4% because I'm going to claim my interest as a tax deduction.
Yes, sir.
Got that?
Yes, sir.
Great. Okay, let's look at cost of long-term loans that are not listed. Let's have a look at, okay, so they talk about different rates. The LIBOR, the JIBOR, these are all different rates that interbanks, or that banks use. It's an interbank lending rate that the banks use to quote on certain products like bonds and so on. Right, so that was just a note about long-term loans that are not listed. Not listed meaning it's not on an exchange. There's no buying and selling of those assets.
Yes, sir.
Okay. The second bit is the cost of equity. This is the Gordon growth. There we go. Gordon growth model. There's it there. NB. Okay, there's the formula. Right, the formula looks different to the one that we spoke about last time. Okay, instead of writing KE, I just put R. R is the rate. Okay, so to write this in a different format, PV equals dividend 1 over R minus G. Okay, did you get those notes that I emailed to you?
Yes, sir.
Okay, we're not going to cover them now. We're not going to cover them anytime soon. I'm going to leave them for toward the end of the course, where we'll use them as revision notes, because all the formulas that you require are on there. Okay, and I'm going to revise concepts like present value, future value, bond calculation, and so on.
Yes, sir.
Okay, so that's the formula that you'll actually use. Dividend 1 over R minus G. Okay, G is your growth, R is your rate, div 1 is your first dividend at time 1. Oh yeah, but Unam, you've done DSC, so you actually know this. Didn't we do discounting in DSC?
Sorry, sir?
Didn't we do discounting in DSC?
Discounting, yes, so we did.
Didn't we do Gordon growth model there?
I don't remember the Gordon growth model, but I do remember discounting.
Oh, okay, so maybe I'm thinking another subject, possibly. Okay, I can't remember offhand what DSC covered in terms of the specific chapters. I don't think it covered this then, yeah. So if it didn't, then this is new.
Yes.
Okay, PV equals div 1 over R minus G. Got that?
Yes, yes.
Okay, let's do a working. Here's one. Read this and tell me what variables do I have in the question. What is my R, what is my G, what is my div 1?
This is activity 13.2, right, sir? Okay. Okay, Super Limited is a listed company that has just paid a dividend of R1.30.
Just paid. What does that mean?
Beginning? No.
Time 0, yes. So what do you want? Do you want the dividend at time 0 or you want the dividend at time 1?
At time 0.
No. You want
Time
the dividend
1.
at time 1 because the formula says D1.
Yes, oh, yes.
Div 1. You see that?
Yes, yes, sir.
Okay, so if it's just paid meaning time 0. How do
Yes,
I get
sir.
from time 0 to time 1? Compound for one period.
Yes, sir.
Okay, so if I compound for one period, I'm going to times by 1 plus the rate, the I. See that?
Yes, sir.
Okay, what are the variables do you have? Give me R, give me a G.
Sorry. Okay. Each the expected rate of return for the ordinary shares is 14.5.
What is that?
Would this not be my R, my rate? Yes, this would be my rate.
And
then my 8% would be my G, so this would be my growth.
correct. There's your denominator, there's your numerator. Your I is going to be 14%, 14.5%.
Yes.
Okay, type that into your calculator. Do you get this answer?
Wait, with this one, would I still be using my financial? Or
No, you would use normal scientific.
Okay.
Normal scientific.
Okay.
Brackets 1,30 times open brackets 1 plus 0.145 close bracket divide by open bracket 0.145 minus 0.08 close bracket equals. Did you get that?
Almost. I'm just doing the denominator.
Yeah.
So. Great. Okay. 0.08. No, I didn't get that. Sorry. I don't know what I did wrong.
Type this in again. Okay, type it as is.
Okay, let me just see how yes, I got that. Oh shit, I think it was here. That's where I got it wrong.
Divide by open brackets. Equals. Did you get it?
Yes, almost. Sorry. Oh, sorry. You know what I keep doing? The mistake is the brackets that I'm not adding. It's not that I don't have the...
You have to put brackets. Must put brackets. Brackets make it better.
0.145 minus 0.08. Yes, I got... But then I didn't get that answer. And I did it exactly like that.
What did you get?
I'll tell you now. Let me just look again if I'm not the one making a mistake. Minus... Yeah, I put it exactly like that.
Sorry, growth rate. I've written down the wrong rate here.
Okay.
0.8. It's not the R. It's the growth. Sorry, it's the growth. That's not right.
So it's okay.
Just change that figure to 0.8. Sorry,
okay.
That was my mistake.
All right, now I got 21.60.
That's better. Okay,
yes.
I'll just be careful with that. I made a mistake. I wrote down the wrong rates. Okay, good.
Straight.
Right, have a look at this. Calculate the cost equity. Cost equity? Can you use Gordon growth? Yes, you can. This equation that I've given you here is just Gordon growth rearranged.
Yes,
That's
sir.
all. Okay, we can still work it out using Gordon growth. So here's the example. Okay, what is Gordon growth? PV div 1 over R minus G. Okay, what's the market price? 80. The next expected dividend is 4 Rand. So next expected, that's important. So is this a time 1 or a time 0?
It's a time 1.
It's a time 1, good. Okay, so that's 4 Rand over R minus G. So R minus 0.08. Okay, can you use arithmetic to solve for it?
Yes, sir.
Yes, you can. Take this to the left. So you'll have ATR minus, let's quickly work that out. 80 times 0.08 is 6.4 equals 4. Okay, take the 6.4 to the right, so I get ATR
6.4 plus 4
equals 10.4. R equals 10.4 divided by 80.
80.
What do you get as an answer?
10.4 divided by 80 is 0.13.
There you go. Same answer. So do you need another equation? I don't need another equation. I can just use the same equation here, Gordon growth.
Yes.
Okay, so Gordon growth is the equation. There's it there, NB. This is the one that you study. As long as you've got that, you just plug everything in, do some mathematics, get the right answer. Is that alright?
Yes, sir.
Okay, great. Okay, capital asset pricing model. This is looking at the relationship between risk and return. Okay, we spoke about it earlier. Risk and return is a linear relationship. Do you agree?
Yes, sir.
Okay, so if I'm looking at CAP-M is looking at the relationship between two different variables. Okay, where you've got a measure of risk Okay, so earlier on I spoke about this. There's the return, there's the risk. Right, with CAPM, capital asset pricing model, okay, the measure of risk is beta. Beta is the risk.
Yes.
Okay, then you've got obviously the reward or the return. Okay, and if we're looking at CAPM, we're looking at assets that have a risk-reward relationship, okay, and we're evaluating if projects should be acceptable or not. Okay, so the capital asset pricing model is looking at when do I actually invest or not invest, and there's obviously points here that are important, so let me highlight this one. Okay, the point over here is the risk-free rate, RF. RF, risk-free. That's what you're looking at there. Risk-free is that point over there. Do you see that?
Yes, sir.
Okay, so the risk-free rate is basically what you've got when the market isn't going to have any risk, and that would be something like a treasury bill. Treasury bill, it's money market.
Yes.
Okay, no perceived risk here, because banks don't really go bankrupt. Governments don't really go bankrupt. Okay, so that's what they consider the risk-free rate. And that's what they're discussing here in the capital asset pricing model. The capital asset pricing model is this: the required rate of return for an investor, okay, that can be used as the cost of ordinary shares of the organization. It takes risk into consideration when working out the required rate. That's what capital asset pricing model is used for. It's used for calculating a required rate of return for a project or investment. Okay, so risk-free we spoke about. Zero risk in terms of treasury bills, money market, short-term money market instruments. Cash, basically. Then you've got market risk. How is market risk measured? It's measured in statistics, and the variable for it is beta. Beta is your measure of risk for the capital asset pricing model. There's the word beta. That's your measure of risk. Okay, return is what you've got on the left. Right, so what factors can influence risk and the effect of the entire market? Well, there's a lot. There's external factors that will affect the market. There's market sentiment. There's people's opinion. A lot can affect the market. When we talk about market risk, we're talking about risk that you cannot diversify against. Okay, so do you agree, if I'm investing, I'm going to invest in the market. And the market is going to have a certain amount of risk, which is called undiversifiable risk. That's market risk. Okay, you get diversifiable risk. Diversifiable risk would be risk that you can diversify against. Okay, you can reduce the risk. That's what they're looking at here. Specific risk is called unsystematic risk. Okay, so there's a few different words. Undiversifiable slash market risk slash systematic risk. Those are three different words that describe systematic risk. Okay, so that describe market risk, which is investing in the market. Okay, it doesn't matter where I invest in the market, but if I'm invested in the market, I'm going to be subject to a certain amount of risk. Does that make sense?
Yes, sir.
Okay. Right, then they've given you some factors that affect that. They've given you some assumptions here, and then they've given you the equation. Okay, make sure you know what the equation is for CAPM. That's very important.
Yes.
Right, I'm going to write down this equation in words. Okay, so CAPM that's the CAPM formula. In words, it will be this. required return equals risk-free plus beta times by the market return minus the risk-free return. Okay, that's what you're looking at. Okay, that's the formula in words. Right, RF is risk-free, RF is risk-free. B, this fancy B symbol is for beta, beta. Alright, then you've got RM. RM is the market return. KE is the required return. Okay, it doesn't matter really what variables you use, as long as you remember this. This is actually more important.
Risk-free.
Got that?
Yes, sir.
Great. Okay, so here's an example. Capital structure of the business has the following optimal capital structure. Debt 25, equity 75, tax rate 28, beta 1.3. Investors expect earnings dividends to grow constantly at 7%, that's G. Previous year dividend, okay, if it's previous year dividend, what is that?
Term 0.
Correct. There's it there, D0. Current market price 60, risk-free rate 6%, market premium 5%. Calculate the cost of ordinary shares. So PV equals div 1 over R minus G. What is my div? Div 1 would be 3 Rand 70 times 1 plus the growth. R minus G. What is your R here?
Our R is our R. What's our rate?
Not given. What must you use?
No, it's not given.
Cap M.
Yes, sir.
Okay, so cap M is another step that you need to do in order to get the rate. See that?
Yes, sir.
Okay, so cap M is the risk-free. What is the risk-free here? 6%. 6 plus. What is the beta? We saw the beta here. There's at 1.3. Times. What is the market return? Here they said the market risk premium. Okay, so if it's the market risk premium, that means it's the additional amount. Okay, which is the bracket, which is 5%.
So we would do the cap M formula to work out our R.
Exactly.
Okay.
Okay. Then you get 12%. There's it. That's your cap M.
Yes.
12%. You see that?
Yes, sir.
Okay, they said determine the cost of ordinary shares. Okay, using the constant growth model, using the cap M approach. Right, so the one we got was there, 12.5%. We still need to work out the other one. So R we need to calculate. Okay, well we calculated R. Did they give me G?
Yes, it was 7%.
Yes, they did. So G here is 0.07. Did they give me a PV? Yes, they did. There's it, 60.
Yes, they did.
See that?
Yes, sir.
Okay, so 60 equals div 1, which is 3 Rand 70 times 1 plus the growth over R minus G. Then you solve for the rate. Maybe let me write that down. That's the end of this chapter. Yeah, let me do this one again just to show you this. Okay, let's get rid of all that other stuff so it's neater. Okay, so have a look at the question. What is the question asking you for?
To determine the cost of ordinary shares.
Correct.
By use. Yes.
Cost of ordinary shares. That means find your R. Okay, so what do? I write down PV equals div 1 over R minus G. Okay, PV is 60 Rand. Div 1, 3 Rand 70 times 1 comma, what's the growth? 7%, so 1,07.
Yes,
Close brackets over R minus 0,07. Okay, take that to that side. So 60R minus Let's work that out. 60 times 0.7 is 42, 4,2. Okay, equals 3,7 times 3.7 times 1.07 is 3,975. 959 actually. 959. Okay, then add 4.2. I get 8.159 equals 60R. Solve for R. Divide that by 60. I get 13.59. Is the same as what they've given you here. 13.59 is there. 13.6.
Yes, sir.
Okay, so you just have to do the arithmetic. It doesn't matter which formula you use. That's why I said, just remember one equation. The equation that you need to know is this one. Gordon growth. PV equals div 1 over R minus G. That's all you need. You substitute, you solve, and then you get the right answer anyway. So you still get 13.6. Got that?
Yes, sir.
Okay, great. Alright, so I'm not going to finish this next bit. It's just too much to do now. And obviously your connection's been quite bad this week with the rain and the lightning and that in your area. So I'm going to leave this last bit, chapter, what's the next chapter? What I would suggest you do as practice, self-assessment activities, NB. Okay, I'm going to give you some homework. Okay,
yes.
You've got self-assessment questions here which look at what we've covered so far. It's working out Gordon growth. PV equals div 1 over R minus G. Okay, that was the one equation. Okay, using your financial calculator to work out bonds.
Yes, sir.
Okay, working out I over Y. There's examples here, and they give you answers as well. So I would suggest you practice with those. Okay, I did some of these in your assignments. Well, I want to try to get to past papers so we can do 1 or 2 of them before your actual exam. You're only writing in November, right?
Yes,
okay, so we've still got some time. We just need to try to do a bit more next week, because this week I was actually planning to cover chapter 14 as well today, but we're not going to be able to get there. So I'm going to ask you to go through these self-assessment questions. Okay, there aren't that many. I think there's 12 in total. No, two examples, well, 2 questions in total, split up into other subsections. Okay, 14 we'll leave for next week. We'll start with it, weighted average cost of capital. It's a very short section. It's just looking at your weighting of debt and equity, multiplying the one by the other, and then getting a weighted average cost of capital, which is called the WACC. Alright, so that's where I'll start next week. We won't cover it this week. And then we'll keep going through the rest of the textbook. After today, we're actually halfway, because we're on study unit 14, and I think there's 28 in total, if I'm not mistaken. Alright, Unam? Are you still there? Okay, looks like Unam's connection has dropped again.